In this video, we will cover some reasons to be concerned from a technical perspective and some possibly surprising signs of stocks holding up better than one might expect heading into cliff votes on the last day of 2012 or early in 2013. As we prepare for a week that promises to have ongoing and contentious debates in D.C. relative to the fiscal cliff, let's talk a little bit about the mixed picture from a technical perspective for stocks. On the bearish end of the spectrum, daily charts in numerous markets don't look good. There's really no way to sugarcoat that, especially MACDs, which are showing slowing momentum. In many markets, we have bearish crosses on numerous daily charts. From an intermarket perspective, our stock-bond ratio charts, many of them weekly charts, starting to roll over in a concerning manner. And if you look at the long side of the market relative to the short side of the market, those charts also are concerning at this point and tell us that we cannot give our long positions much more rope here. On the positive side of the ledger, our models, which are based on technicals from daily, weekly, and monthly charts, still remain in neutral to bullish territory. None of our models have crossed over into bearish territory. In fact, our composite model, that's the average of our three main market models, closed Friday at 50 on a scale of 1 to 100, obviously telling us it's right in the middle. It's not particularly bullish. It's not particularly bearish. Another area that's holding up well are numerous intermarket risk-on, risk-off charts that we'll present during the course of this video. I think when you see these charts, see how they have acted in the past, you'll have to agree that so far they're holding up better than expected. We'll cover numerous charts that can help with possible areas of support. You can pause this if you'd like to write some of these down, but what this shows you is there are bands or areas of support that fall between 1391 and 1396. This number out here tells us what the average is of the numbers that fall in between this. So these are bands of possible support, areas where buyers may potentially step in, especially if Monday and the first trading day of the new year are bearish with problems in Washington. These are bands that you can watch on the Nasdaq. And these are potential areas, bands of support for the Dow Jones Industrial Average. Back here, the reason why this is yellow is a breach, especially a close below 1391-ish on the S&P 500. From a trend perspective, would have us say that the trend is most likely shifted on a daily chart from up to down, and a close below these levels would increase our concerns and may also have us selling into strength potentially on any bounce. To view the video in full screen mode, use this icon in the lower right-hand corner of your video player. To improve the clarity of the charts, use this icon in the lower right-hand corner of your video player. This is a daily chart of the S&P 500 index on Sunday, and as of the close on December 28th, one quick point. While we will hear that the S&P 500, barring a disaster on Monday, was up for the year, it's clear here that the uncertainty in Washington and ongoing uncertainty in Europe has adversely impacted the financial markets. Since the end of Q1, on 3/31/2012, the S&P 500 closed at 1408. We've basically gone nowhere. In fact, we've lost a little ground in the last 90 calendar days, closing Friday at 1402 on the S&P 500 index. What this means is the markets have been impacted by what's going on in Washington, and if there's not a resolution, we have to be prepared and respect the potential for additional downside. This is a daily chart of the Nasdaq as of the close on December 28th. A few quick points. These are Fibonacci retracement levels in this box based on high-low closes and just closing prices. These fibs are here. The fibs for this move are here. Two of them intersect at 29.58 and 29.61. We closed at 29.60. If that doesn't hold and we get nothing positive out of DC this evening, you've got some clusters of possible support above 2,900 on the Nasdaq. Notice this consolidation here could be potential support in this purple box. If 2,900 does not hold, you could envision a relatively quick move like this one here or this one here down towards 28.25-ish or somewhere in the neighborhood of 28.50-ish here. Another point, many markets have bearish MACD crosses, which obviously is concerning, but we will note that you can get bearish MACD crosses on daily charts and then still go on to make higher highs. Bearish cross went on to make higher highs. This is concerning, there's no doubt about it. Potential support in this area here for the Nasdaq. This is a daily chart of the S&P 500 with parallel trend lines, just trying to get some idea of where support may come in. You can see support, support, resistance, support. This is a parallel trend line here. Support, support, resistance, support. You noticed Friday we closed roughly right on that trend line. Come back here. This is a parallel trend line with this line here. Support, support, support. We're near it. So there was some basis here to be patient on Friday. From a bearish perspective, we closed below all of these levels. Fibonacci retracements, when you use closing prices, come in at 1394 and 1396. If you retrace this up move from the June low to the September high, your fibs are 1394, 1372, and 1350. So we have 1394 close by. If we take this move here on a closing basis to this move here and look at the retracements, they're 1422, 1409, and 1396. So these two numbers here are fib numbers. This is another parallel trend line here, 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 and here. You can see it comes in somewhere around 1390. If that doesn't hold on this chart, we get the second parallel trend line, support, support, that comes in somewhere in the neighborhood of this fib at 1372-ish, 1378-ish on the S&P 500 daily. This is the exact same concepts. Now we're just looking at the daily using high-low close prices. Our fibs in that case are 1393 and 1395 is an area to watch. From a parallel trend line perspective and simple trend line perspective, we closed Friday at the intersection of fibs, these purple trend lines, and these orange trend lines. If this doesn't give away, you can visualize potentially a gap down on Monday, coming down all the way to this parallel trend line, which would take you all the way into the 1360 range. This is a daily chart of the S&P 500 as of a close on December 28th. Just a quick point, we've shown this and discussed it on short takes and on Twitter. If we have weakness early next week, you could potentially see support at 1390 and change here at this blue trend line, or if we're in this channel here, support, potential support comes in at 1380 and change. Let's call it 1383-ish, 1384-ish, 1385-ish as potential support next week if we see a weak opening. This is a weekly S&P 500 chart. 1397 is possibly the last line of defense. Here we closed at 1402, below 1408, below 1403, and 1406. You can see here relatively quick movement could take place all the way down to this trend line here, which aligns with 1380 and change, 1383, 1384-ish. If that doesn't hold, horizontal resistance 1363 here, 1370 here, 1362 here, and 1360 here. This trend line off of the low comes into play somewhere in the neighborhood of 1380-ish, 1370-ish and change as well. It's a daily chart of the Dow Jones Industrial Average as of the close on December 28th. Some potential support in the 12,850 and above range. Point here is it appears as if the Dow could take a bigger plunge in terms of lack of support below these levels here. This is a weekly chart of the VIX that we've shown on Twitter and on short takes in the past. We've noted that we were concerned about this look here that is similar to this look here. You can see when you get this breakout here, the S&P 500 performed poorly. This is not a good sign that we have this breakout. However, if we can get some type of deal out of Washington, you can make a case here that we've got potential resistance for the VIX using these parallel trend lines here that we'll keep an eye on next week. Now we'll shift gears from potential downside and support if we don't get a deal in the next few days out of DC to some charts, intermarket charts that are looking bullish, that don't really support an imminent bear market case. This is a weekly chart out of a chart list, out of hundreds of charts that we use, risk on, risk off. Weekly copper relative to gold. And you'll see that when the ratio typically rises, rising here, the stock market does well. Ratio rises from here to here, stocks do well. Ratio rises, stocks do well. You can see currently the ratio is rising, and it was actually up last week during the fear session for the fiscal cliff. Typically, when the market's weak during this period here, the ratio is weak. Stock market weak, ratio very weak. Stock market weak, ratio very weak. This really doesn't align with the longer-term bear market outlook yet. Keep an eye on this, and if this chart and the ones that follow do align with it, it would make us become even more defensive. We've taken a few moderate baby steps away from risk. If these charts roll over, we'll have to start taking larger steps away from risk. Now we're looking at a weekly chart of the Morgan Stanley Cyclicals Index relative to the S&P 500. As most of you know, cyclical stocks are stocks that tend to be tied to economic growth. Cyclicals do well when the economy is strong or the expectations are that the economy will be strong. Cyclicals tend to lag during periods of fear or periods where market participants believe that economic growth will be weak in the future. You can see here during the debacle in 2008, cyclicals relative to the S&P 500 aligned with a bearish outlook. Here, these red boxes, and we're looking at a ratio here. This is cyclicals relative to the S&P 500 here. These red boxes show us what a weak period in the stock market looks like. This is weekly S&P 500. Serious correction, serious correction. Let's go up. Typically what you'll find during a correction in the stock market that this ratio falls. This ratio falls. Well, lately the ratio has been rising. Now, admittedly, it's hitting resistance, potential resistance here. However, last week, during the fear for the fiscal cliff, this ratio was up, which really doesn't align with risk off. In a similar vein, Williams percent R, our momentum during periods of risk off, tends to be weak. Weak, it's spending time in the lower half of the range. The current Williams percent R, or momentum for the ratio, really looks nothing like this. RSI during a stock market correction for the ratio, weak. RSI during a correction tends to be weak. This RSI is still rising. So like the previous chart, if this rolls over and momentum rolls over, that would increase our concerns about potential significant downside. MACD during a stock market correction, weak stock market, MACD for the ratio tends to be weak. Weak stock market, MACD below the center line, ugly. Have to admit that this MACD looks nothing like a typical MACD during a stock market correction. Same. Black MACD. This is the histogram here. This is MACD here. During a correction, it tends to fall. During a correction, it tends to fall. Well, here it's rising and above the center line. This is the same ratio. Now we're looking at a monthly chart. You can see on the monthly chart, it's trying to break out in a bullish manner. Obviously, this breakout can be erased and it can turn into resistance on the last trading day of the year, which is obviously dependent upon what happens or does not happen in Washington. The Copic curve, typically when the Copic curve turns up from below zero for this ratio, that's a good sign. Copic turns up, look when it did. 2009, a bullish period in stocks followed. This Copic curve currently still looks relatively healthy for the monthly cyclicals relative to the S&P 500 ratio. While there's no question there's numerous things to be concerned about as we head into the last day of the trading year, as well as the balance of the week for the first trading week of the year, this is another chart that doesn't seem to align with the doomsday scenario. This is the European Financials Index, Dow Jones European Financials, relative to the S&P 500. Just want to make a point. Williams %R measures momentum. Here, bullish momentum for this ratio. Look when that happened. 2009, which was a bullish period for stocks and a good time to be invested in 2009. Have to admit that this bullish momentum for European financials relative to the S&P 500 in 2009 looks very similar to the present day. We also have a bullish breakout that's trying to take place. And this is a weekly chart, so this was locked in as of last week. What does this tell us? It tells us that if there is volatility, ongoing volatility and downside due to the fiscal cliff, that we should try to keep an open mind that stocks could find their footing and surprise on the upside. This is another ratio chart, a weekly ratio chart that currently is not aligned with the longer-term bearish case. This is Brazilian small-cap stocks, the BRF ETF, relative to the S&P 500. When the ratio rises, BRF is outperforming the general stock market. When the ratio falls, the stock market is outperforming Brazilian small caps. This is a stock market correction here. You'll notice in the early stages of a serious correction, the ratio falls. Early stages of a serious correction in the stock market, the ratio falls. Correction in the stock market, ratio is weak. Last week, this ratio broke out in a bullish manner, which again does not align with the longer-term bearish outlook and tells us that as long as this ratio continues to be strong, then we should keep an open mind about the S&P 500 possibly bottoming after some type of short-term resolution on the fiscal cliff. This is a weekly chart of XLB materials ETF relative to the S&P 500. You can see when the ratio has a bullish breakout and then rises, the stock market, which is shown here, tends to do well. Ratio breaks out, rises, stocks do well. Ratio breaks out here and rises, stock market does well. In the present day, we have had a breakout, breaking out of this trend line, and we just made a higher high relative to this high last week. It's hard to argue as of the close on December 28th that this ratio looks bearish. Momentum is kind of weak here, I'll give you that. This is another ratio that tells us to keep an open mind. Last week, this ratio was up 1.48%, telling us that XLB actually outperformed the S&P 500 on the week ending December 28th, Friday. If materials are outperforming the S&P 500, that really doesn't align with the longer-term risk-off case. Like the previous charts we've shown, if this ratio rolls over, then we would become more concerned. But as of the 28th, this tells us to keep an open mind about a bottoming process and stocks potentially trying to push on to make a higher high early in 2013. This is another intermarket chart that we use in some of our chart lists that we use to monitor risk-reward ratios for the general stock market. Now we're looking at a weekly chart of XLP, consumer staples, the ETF relative to the S&P 500. As you know, consumer staples tend to be a defensive sector in the market, things like toothpaste and milk that you buy regardless of where the economy is. Typically what you'll find, here's the stock market. During a correction in the stock market moved from here to here. Consumer staples, being a defensive sector, tend to be strong relative to the S&P 500. This is what a stock market correction looks like. Weekly S&P 500 here, the ratio rises. Stock market correction, the ratio rises. Like many of the charts that we've shown previously, this chart, as of the close on the 28th, really doesn't align with full-bore risk-off running for the exits. Last week, you would expect, with risk off and concerns about the fiscal cliff, that XLP would be outperforming the S&P 500 similar to these periods. It actually underperformed the S&P 500 by a little bit last week. So as long as this remains looking like this, we will somewhat give the bullish trends the benefit of the doubt. Getting a little bit more creative here, another ratio chart. This is the ratio of the emerging markets ETF, EEM, which tends to be a more aggressive play, aligned with economic growth and dollar weakness and fears of inflation, relative to a defensive ETF, XLV, or healthcare. You're going to go to the hospital or the doctor when you're sick, regardless of what the economic outlook appears to be. This is a stock market correction, S&P 500 weekly. Typically in the early stages of a correction, this ratio is weak, which is what you would expect. Healthcare is outperforming emerging markets here. During a stock market correction, this ratio tends to be weak. During a stock market correction, ratio tends to be weak. This is another chart that has you scratching your head or telling you to be open to maybe things aren't as bad as they appear, or they may appear in the next few days with the fiscal cliff panic. You actually have this ratio making a higher low here and breaking out and making a higher high last week. As of the close on December 28th, EEM crushed healthcare stocks last week by almost 3%. Momentum, Williams percent R, confirmed this breakout. So if this ratio gets weak and holds here, this would be a good potential entry point for risk assets like stocks and commodities in emerging markets if they can get a cliff deal together and risk assets can find their footing. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or offer to buy or sell any security or any related financial instruments, nor should any of the content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Cyclical Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.